The whole system is going to collapse. And none of us own enough cash. If the path of least resistance is inflating our way out of the system. And so...
Wait a minute, what do you mean the whole system is going to collapse?
Special coverage from the floor of the World Symposium is brought to you by Palisades Gold.
Does the latest cooling inflation indicate to you or to markets overall that inflation is over? Well, that's a question we're exploring with Tavi Costa, co-founder and CEO of Azuria Capital. And more broadly, what Tavi is looking at right now for the best plays into the end of 2026. We have a few important questions. If the Fed raises rates into September or into the end of the year, is that a gold buying or topping signal? And furthermore, with semiconductor stocks selling off, especially abroad in Korea, does that present an opportunity to rotate into that sector, or is that an indicator to rotate out of tech? Welcome back to the show, Tavi. Good to see you.
Good to see you too, my friend. Would you like me to answer that question already?
Yes, please, Tavi. Let's go right into the answer if you have one for us. The great rotation, is it happening right now, and how would you be positioned?
Yeah, look, I'm not sure I would rotate back, into tech. I think if anything, things are so overbought and so concentrated in that aspect of the market that I certainly would shy away from having any exposure to that at all. I think that we need to take two assumptions when investing. Just my 2 cents, and that's the U.S. has two limitations, if I could say. I'm not sure we can really embark another tightening cycle like we saw back in 2021 when inflation got out of control after COVID and the Fed decided to go through multiple hikes in interest rates that basically caused the metals to go through a correction in that time. So I'm not sure we can really go through that again. I really don't believe that that's going to be the case. And number two, I don't think we can really afford a war like at this point. I mean, I think that those two things, you have to sort of act accordingly. And in other words, if metals are selling off because of that, and you're seeing some other assets getting discounted because of those two reasons, I think you need to act accordingly. And so I view this as a very significant opportunity. There's not going to be a lot of times in a secular bull market for metals that you're going to see the market as discounted as it is. And the beauty of it is that you're seeing some of the best and well-run businesses in the mining industry now down 45, 50%. So it is to me a very, very important opportunity that I'm willing to put capital to work in this situation.
Okay. That's the focus of our conversation today, is where you're putting your capital into, how you're putting your capital to work, and whether or not you're rotating back into gold mining stocks after their big decline. GDX is down to something like 35% year to date, but we'll come back to that. On inflation, I mentioned in the introduction, inflation data has been softer. The latest CPI print came in not only lower than the previous month, but lower than actual Wall Street consensus expectations. Now, Federal Reserve Chair Kevin Warsh did say in his testimony to the House Finance Committee earlier this week that inflation, long-term inflation, is a monetary phenomenon, or at least caused by monetary policies. That's what he said. Long-term inflation is caused by monetary policies. Do you agree?
Agree 100%. And if you look at the money supply of the U.S., of which the Fed has some control, but not full control over it, has gone up tremendously, right? It's going straight up again. Fiscal discipline is out of the window. I mean, I think Kevin Warsh put some incredible commentaries out there, but I'm not sure he can do much. It sounds great, everything he's saying, but what is he? I'm very skeptical of everything that he's saying, because despite the fact that it sounds wonderful, all the changes that he's looking to do, this sounds to me like Doge, if you recall, when we talked about reducing spending and making a bunch of changes fiscally. And guess what? We're 2 years from that, and there's no changes. In fact, the fiscal situation has only gotten worse. And now we are also engaging in a war. And so It is, spending is not likely to stop anytime soon. And that, if it is a monetary phenomenon, then act accordingly here. Like, this is literally what's happening. And inflation, if that's the case, and inflation is not going to stop. And so maybe government data, maybe they will manipulate the data and show different things in different measurements, which is very possible. I mean, they're literally making changes that haven't seen in a very long time, or we have seen there are precedents of changing the measurement of inflation. We all know that. But have we seen this level of commitment from a Federal Reserve recently? No, this has been definitely a change in the way we may approach how inflation is being calculated, and that will probably be all sorts of justifications to allow the Fed to to reduce rates and actually be much more accommodative than people believe. So I stay very firm on that view, because if we're not going to do that, then the whole system is going to collapse. And none of us own enough cash if that's the case. Really, that's going to be the case. And so I'm not sure even Trump would allow that to happen on his own, under his own leadership. So I think that, as always, we've always talked about this, but the path of least resistance is inflating our way out of the system. And so that is the more likely path that we are likely to see here.
Wait a minute, what do you mean the whole system is going to collapse?
Well, if we tighten conditions and we're really going to be serious about inflation, which is, at levels we haven't seen, in a very long time. And I'm talking about real inflation, not just all these crazy metrics that government and other people tend to see. I mean, walking on the grocery store, shopping and doing grocery shopping or anything along those lines, or any service businesses that you see, inflation is definitely at a level from 5 years ago that it's a measurement that it's way above anything that it's been reported so far. And if that's the case, we're going to take it serious, all those implications that we're seeing in society, and we're going to be tightening conditions accordingly. What do we need? We need 15% interest rates, 10% interest rates. That would be insane. The system cannot afford this. In fact, the system can barely afford the current interest rate regime. At 3.75 right now, the entire treasury market is borrowing money at a rate that is just unsustainable. We're trying to grow the economy at 4 to 5% just to pay down the debt. For how long can we be doing this?
So what you're saying is we can't afford to go to war with Iran.
I don't think so. I don't think we can. And it's just not a question of me agreeing or not with the war. Like, that's not the point. It's not a political statement. All I'm saying is we're not in a position that we can just keep spending this type of capital. Or that's precisely what you're seeing. The movement in the treasury market is exactly because of that. It's because spending is out of window. It's not the way it was praised by Doge literally 2 years ago that we would stop spending. We're seeing the opposite of that. And so, hence why a lot of assets are performing the way they are. We're, in my view, not too far from seeing an emerging markets, sort of volatility in the treasury market. I mean, the treasury market is almost as volatile as the treasury market for any other emerging market nowadays. And so, what are we doing here? I mean, this is the treasury market, just to be very specific, is what holds the key for the dollar, right? Like, it's used for a collateral for every country in the world, and sovereign institution, central banks, that's what they use. And if we start seeing this level of volatility persist, it's going to be a problem very quickly. So the system cannot allow this for too long. And, so I don't really buy into this conversation that any Federal Reserve chair has that level of control that Kevin Warsh is referring to. I think this is his actions are highly limited.
Before we continue with the video, let me tell you about one of the most important problems of owning gold. So gold has been a store of value for thousands of years, for as long as people can remember, but it doesn't generate an income like many other assets. That's a problem. But that's also where today's sponsor, Monetary Metals, comes in. Monetary Metals offers investors a way to earn yield on their gold paid in physical gold. Through its leasing platform, investors can earn up to around 4% annually, with yield paid monthly in ounces rather than dollars. That means your return is measured in gold itself. The gold remains your asset and can be redeemed at any time. Thousands of investors are already earning a monthly yield in gold through Monetary Metals. Visit monetary-metals.com/Lynn, link down below, or scan the QR code here to learn more and get started. And you can start earning a real yield in gold today.
If we do have data that shows us that inflation is coming down, though, how would you interpret the recent data? Yes, data can be manipulated. Yes, they can change definitions. Yes, they can change measuring systems. But take a look at not just CPI that I brought up earlier in the introduction, but also PPI, producer prices, not just disinflationary, but outright deflationary for the latest month, with goods prices down 1.4% on the month. Overall, negative 0.3% in June.
On the month over month, not year
month over month. Oh yes, you're right. You're right. You're right. Yes, that is an important distinction. Month over month. Thank you for correcting me. Month over month. But still, the trend is disinflation, at least for the latest couple of data points. Tavi, people are looking at this and probably thinking to themselves, inflation is over. Gas prices have come down because the war in Iran has reached a pivotal point, and now it's reigniting. But that's a different story, which we'll talk about. At least in the short term, it looks like inflation expectations are coming down a bit, and consumers are looking to see a bit of a reprieve in prices. Is that your expectation?
What's fun about this situation, I've been covering macro for a long time, and I have a very strong feeling that this type of data is becoming completely relevant. And it's not me just trying to justify my views by saying that the data that is being presented against the view that I believe is proving otherwise, and rather just to say that inflation in the real world has not gone down at all. I mean, we can talk about growth. We can talk about how some things in terms of growth have decelerated, but we're still expanding on prices of goods and services in the US and other parts of the world in a degree that it is unsustainable. What I would say, look, there are some data points that I would point out that have come down that are going to become Kevin Warsh's best friends. You can call it the Trueflation index. If you look at that index, it's gone straight down, right? And it's claiming that there's no real inflation in the system today. No, right. I don't think that's. Government data is becoming sort of a joke here. It's hard to believe in any of these numbers. But look, if that's the case that people want to make, that inflation is, I would say there's two types of inflation in this system. There's government data and there's real inflation. I think real inflation is even hard to measure, but we all know it's not going lower, it's going higher. The government data has decelerated here recently, and it's exactly what is used to impose monetary policy. And if that's the case, I think it reinforces again Kevin Warsh's potential direction of policy that would be easier, not tighter. And that's not what the treasury market as well is pricing in. I mean, we're seeing hikes already. 100% probability is already priced into the markets, and I don't buy into it. I don't think we're going to see rate hikes. I really don't think that that's going to be the case. And in the next 12 months, and maybe we see one. Maybe I'm wrong, and we see one of them. But I don't think there's much of room here to really impose that type of policy moving forward.
Well, Tavi, you're looking at it from the perspective of what should the Fed do? Yes, you're right. And look at this chart that you've tweeted here. The U.S. 10-year real rate has gone up. It's the highest level in 2 years in a row. When Scott Bessent said, to judge him by the 10-year Treasury, well, the markets are the ultimate judge of fiscal discipline. Remember, the U.S. simply cannot afford both the war and higher interest rates. So that's what you posted on X. So given that, that's what you think. The Fed should not be raising interest rates. But what data would they be looking at that would make them raise interest rates anyway? In other words, what is the Fed's framework that they're basing their judgment on?
Well, I think that the only way to justify a rate hike in these days would be potentially looking at obviously the energy price and what's happening with the war. And in a normal world where there's no debt in the system, you should be raising rates in this environment. Look at what's happening with the equity markets. Equity markets at all-time highs. Earnings are going in a vertical line. So there's definitely plenty justifications to hike rates. The problem is, again, the system cannot tolerate much higher cost of capital here. Maybe one rate hike. Again, we're growing the economy at 4 to 5% just to pay down the debt. Like, what are we talking here? We're going to raise rates again. About 25 to almost 1/3 of the entire debt needs to be rolled over in the next 12 months. So we're just going to increase the cost of the debt overall. Like, we're just inflicting that pain in ourselves. I don't think that that's what we want to do either. So, and more importantly, I think of fiscal spending as a pie, and there's a very growing percentage of that pie, which is on interest payments to GDP. That used to be nothing, and now it's a huge amount of the fiscal spending that we have, and we need to reduce that in order to spend money in infrastructure, healthcare, in education, all sorts of things, all sorts of sectors of the economy that is needed when it comes to that. And so I would think that that's a bigger priority for policy than hiking rates to accommodate for energy prices. We literally cannot afford that.
Okay. What does that mean for the US dollar if the debt continues to increase? Look, in theory, economic theory should tell us that the home currency, domestic currency, should devalue if debt increases, all else being equal. That has not really been the case, at least in 2026. The DXY, which is the dollar relative to other currencies, has strengthened since the beginning of the year, gone down a lot since last year, though. Your comment on the recent movements in the dollar and ultimately how the debt situation will impact the dollar going forward.
Yeah, look, I think the dollar has been an extremely strong currency recently relative to other fiat currencies, and the likelihood of that continue to be the case is also very unlikely in my view, and that's mostly because when you think about, again, the compounding factor of the debt, it comes down to two things. It's not just the fiscal side. The fiscal side is an obvious problem, but there's second side of it is the trade balance. And the only way you adjust the trade balance is either with trade agreements, or you can also make another adjustment, which is through a US dollar that devalues and makes your exports more attractive to other counterparties, and that way increasing or improving our deficit. And we still have to run a deficit on the trade side to provide dollars to the rest of the world. But despite all that, we don't need to run a deficit that is as steep as it is right now. We're looking at a twin deficit problem of about double digits right now, which you can think about this as, I like to say, running a country is like running a company in a sense. You have two sources of revenues. You either collect more taxes than what you spend, or on the other side, you export more than you import. When you're running both of them, a very steep deficit, you're compounding your debt. You're just having a loss in your net income, and you're compounding your debt problem. And so, that's what has been happening for decades in the US, but we're seeing this at a degree that it's now becoming more and more alarming. And so, yeah, I don't see how we do this without having to force the Fed to lower rates, and at the same time cause the dollar to be readjusted much lower as well. So, if we want to continue to use the dollar as a global reserve currency, we need a much weaker dollar. This is way too strong for being in a dollar system, in my view.
What is America's primary economic advantage into the next decade?
There are plenty. The leadership that we have in AI is going to be an important role into that. I think that there are a few things that the gap between the U.S. and the rest of the world is likely to change. Is likely to narrow, if you will. Like let's just think about labor markets. Labor markets in the U.S. have been a pool of labor that we haven't seen in a very long time in history of economics, where some of the best brains of the world are all wanting to come here to work. And that creates an atmosphere of labor markets that we don't see anywhere else in the world today. Now with AI, I think it does help to reduce that advantage in the US versus other parts of the world. And I think that needs to be readjusted on multiple differentiators of businesses in the U.S. relative to other parts of the world. And so but the U.S. is still ahead of, rule of law. It's another thing that certainly is imposed in a much more strict manner than other parts of the world, and still is the best place in the world to work and so forth, and to create a business. Although again, that gap has been shrinking. It's not a gap that is straightening, and we have to acknowledge that. So you're basically seeing that gap shrinking, but the valuation of businesses have not shrinked at all, right? Like it continues to expand relative to other parts of the world. So that concentration needs to be adjusted accordingly, in my opinion. I think we're going to go into the next 5 to 10 years into an era, which is not the end of the world. It's just the cyclicality of leadership in markets may rotate back into the rest of the world. And hence why I think Latin America would be one of the areas that will attract some institutional capital moving forward as well.
Is that due to currency differentials or something more fundamental with the economies growing in Latin America?
It is remarkable that you're seeing some of and not very reported by many people, but if you look at the performance of currencies across in the last 5 years, the best performing currencies in the world have not been developed markets or anything along those lines. It's actually been Latin American currencies, Peru, Mexico, Brazil, all those have actually seen outperformances relative to the dollar. And I think that's a strong sign of smart capital coming into those areas in a significant way. I would say that Latin America also is one of the most unexplored regions of the world when it comes to natural resources, and is becoming increasingly attractive for strategic partnerships with areas like the U.S. that are seeking those resources moving forward. And it's a much easier place to navigate than areas like Africa. So no, I would put a lot of weight on how Latin America will become more and more strategic. And on top of it all, you're seeing a very significant shift in politics leadership that we haven't seen in a very long time. At least in my lifetime, I haven't seen that occur. And so the polarization and the shift towards capitalism in those areas can be a very powerful shift that markets are underappreciating, in my view.
LATAM is very big as a region. I know it's classified as one kind of jurisdiction from an investment classification standpoint, but there's a big diversity in areas, cultures, even inflation rate. The Mexican inflation rate, I think, is less than 5%. Argentina is greater than 30%. Venezuela has a hyperinflation. And so you really have to pick and choose here. How do you decide?
Well, investing, the good news about investing is it's not about where we are. It's about where we're changing towards. And so you're always thinking about the net change we're going to see a year, 2 years, 3 years, 5 years, whatever the horizon is that you're investing. The problem can still persist, but if it's changing in the right direction, you're probably going to make money on your investment. So that's the plan here in Latin America. It's not that it's going to become a perfect place to live, but it's likely to change in a positive direction. And so I do think that there's a lot of cultural differences in the region, but I would argue that the cultural differences are not as far as you see in other areas of the world.
Yeah.
I also think that those parts of the world are very open-minded to resource businesses. And if we are indeed in a hard assets era where capital will be flowing back into hard assets, you would suspect that these companies and these businesses that are running in those countries are going to perform better. Also, I would say that in a lot of ways, like let's take Chile as an example. If you want to invest in Chile today, you're going to take the ECH ETF, and you're probably going to be looking at that as your alternative to invest in the country. It's a country that is highly, highly linked to copper prices as one of the largest, call it the Saudi Arabia of copper. But the problem with that is that when you look at the Chilean ETF, it barely has any mining exposure into this ETF. But the beauty of it is that the ETF itself follows copper prices, because indirectly that copper prices would change completely the direction of the country. And so, you may see copper prices go up 20, 30%. It may help the banks in that region as well. And so, everything is linked to the resource prices in a significant way as well. And so I think that's going to be the core aspect of the thesis overall is understanding if you're right about hard assets, if you're right about this trend that will move back into the commodity space, I would suspect that Latin America is going to be benefiting from that tremendously.
Yeah, here's a chart, by the way, from our friend Ronald Striffler. He called you out on X. One for you, Tavi Costa. This is from Bank of America. Emerging markets enter secular bull phase. Here you see the S&P versus EM with the ratio topping in January 2025. Does the EM market or the EM markets overall, do they follow long-term secular cycles throughout history?
Oh, yes. I mean, look, and funny enough, it's a derivative of the gold space, right? Funny enough, if you get the gold trade right, you're probably going to get the emerging markets trade right as well. Emerging markets is a broad term to talk about as well, because if you look at the index that you're presenting here in this chart, it's actually it's got a lot of exposure to China, which is a commodity importer, not exporter, and actually gets impacted by commodity prices moving higher, and so in the negative way. And so I think there's parts of emerging markets that look more attractive than others, particularly the ones that have there are commodity producers and are able to actually be commodity producers and trade with the rest of the world. Like places like Russia are very difficult to invest, obviously, because of the authoritarian regime that is in place, and the difficulty of getting institutional money attracted to those areas. And so you have that as well, that you have to be aware. But yeah, I mean, look, there has been back in the 1970s, the derivatives of the gold trade are emerging markets tend to perform well. The dollar tends to be weaker relative to other currencies. Those are the most important aspects that you need to be aware of. The early 2000s, we saw exactly the same thing. Now, if you just bought the Ibovespa, the Brazilian index, back in the early 2000s and sold it in 2011, when it was the peak of the commodity cycle, I think you made about 18 times your money. That's the most boring way to invest in Latin America. If you took a little more risk and was smart enough to pick better investments than the overall index, you could have done a lot better than that. And so I'm not saying we're going to replicate those types of returns here or anything along those lines, but I do think there's an opportunity to see something similar.
Speaking of gold cycle, here's an article from the WSJ. Let's just get your opinion. We talked about rates a lot already, but this article is saying that because of higher rate expectations, gold is selling off. Gold was rallying to unprecedented highs above 5,000 a troy ounce earlier this year when Stu Bradley jumped at the chance to sell. This 83-year-old retired financial advisor wanted to pair some of his holdings, doubtful the prices could climb much higher in the near term. Now he's glad he sold. Yes, it's down 25%. That has increased the opportunity cost of holding gold, or the perceived cost of holding gold, which they're talking about. Investors have been worried that the war with Iran could drive up energy prices and inflation, which in turn could lead the Fed to keep interest rates elevated. Okay, that's the key here. What if they're right? What if real interest rates do go up? Do we get a sell-off in gold, further sell-off?
Yeah, no, that's going to be damaging for the gold space for sure. I think that's your bear case, indeed. But I think that sentence that you refer to is probably in hindsight now. And investing is thinking about the future, not the past. And so I think, although the past does help to understand what's likely to be in the future, that's not the case here. What we're talking about is explaining the facts that cause a sell-off. While we can come up with all these reasons, was also very overbought. It was also very over-owned. Gold prices above $5,000 an ounce, and was due for some sort of correction. None of us knew when it was going to happen, and none of us knew how steep was going to be of a correction. But the question when you have corrections is always to think about, does that fundamentally change the thesis for that asset, either if it's a business or a macro asset like gold, or is it, if it hasn't changed, you should probably be adding to your position. I would argue that we haven't seen a fundamental shift on the thesis at all. In fact, I think all we got is a cheaper price to acquire the asset. Yeah. So I would suspect we're in the accumulation phase. And I know it's difficult when markets are going down and most people tend to sort of step back and let the market sort of sort things out, and then they want to step into the market again after you see some sort of relief in the markets. That's definitely not my approach. I don't mind to step in at a volatile environment like we're seeing now. Silver prices are looking extremely attractive at these levels right now, in my view, as well, which is becoming again. I do think gold, silver are in a different environment than copper at this point. Although all of them, the three metals look very attractive. Gold and silver look like more oversold, steeply, in terms of history, and should be bought for those reasons. Copper, very different. Copper is more in a price discovery situation, really being driven by a market that we saw with gold prices, 6-7 months ago when it was accelerating to the upside. And that's kind of how it feels like looking at the way copper has been trading.
When you see a chart like this, I'm going to put this back on my screen. Gold on an inflation adjusted basis has not even retraced its 1980 top. What does that mean to you?
Oh, it means opportunity, right? I mean, if that means we're not at all-time highs. Dave, I used to have to answer this question, a similar question back when I was initially investing in silver, where people used to say, well, why would you buy that if that it's still lower than it was in the 1980s in prices? Like, who would buy an asset that is down from 40 years, 30 years ago? And my answer was, like, I wasn't buying silver in the 1980s. I wasn't even born at that time. And so I'm not there to defend that thesis from back then. I'm interested in things that are cheap, under owned, and there's plenty of justifications to take the other side of that view. And I think gold is I think it's a wonderful asset to own for the next 5 to 10 years. It's going to be volatile. We're going to have ups and downs, and I want to make sure I have my arms around the best ways to express that view in the markets here.
Let's take a look at this chart that you love to post, and I've been following this chart for quite some many months now because you started posting it. The divergence between copper and gold. Let's talk about that. What does this mean? And just for a bit of context for the viewers, let me just pull up a copper chart here. Copper and gold have traditionally been pretty much closely correlated. Okay, this is not gold per pound, but I'm just going to use this as a variable to highlight the correlation, nothing more. So ever since the beginning of April, which you've highlighted, the divergence has been getting wider, and now it looks like copper has been trading alongside stocks. The correlation between copper and the S&P 500 is stronger between the copper price and the gold price. Why is that?
Well, look, copper is usually the most volatile metal across all of them, and usually the more cyclical, that is driven by economic changes and forces that we tend to see. What is interesting about copper is becoming less of an economic driven model and metal, and more an asset that is driven by real supply and demand imbalances that we're seeing, that mostly come from structural demand, from construction, either data centers, onshoring, manufacturing, industrial capacity, highways, whatever that is, residential markets. And the other side of it is how supply has been so constrained. A lot of people have pointed out how sulfur prices have gone higher because of the war. All that plays a role here. It's not the main role. Like, it's so important to understand, like, that it's not the reason why copper is divergent because of that. It's one of the reasons, and it's an important reason. But I think that the main reason is because copper prices, from a behavior standpoint, you don't go to all-time highs, break out to new highs and go up 5 to 10% above the prior high and stop there. What you tend to see is sort of an explosion to the upside once you break to those levels, sort of like what we saw with silver when we hit the 40, 50 level, and then it sort of went all the way up to 120. Or when gold was at $2,000 an ounce, sort of retesting prior highs, and then it went easily and quickly up to over $5,000 an ounce. So that's the stuff that we haven't seen in copper just yet. And I think we're in the process of seeing that. Of course, the market is very clouded. There's a lot of things going on that are trying to drive the markets lower, especially copper. But copper has been resiliently, showing a very different behavior that tends to show. It tends to lead to the downside in metals markets like this. And that's not what we're seeing right now. I suspect that this is a stronger sign, for, if anything, for the precious metals side of things, where we're probably, just seeing again another way of thinking about if we are in a bull market for metals overall. What you would see is actually copper prices leading the downside, not keeping up and being so resilient and strong and diverging positively relative to gold prices even. So I suspect that means a lot more for the catch-up opportunity in gold, and also how copper will continue to move higher. It almost feels like, in a certain way, the great analogy for me is almost feels like somebody's trying to hold a beach ball under the water, and copper keeps moving higher.
And billionaire mining financier Robert Freeland summarizes it in his words: "Copper is the new safe haven." You actually retweeted that. Gee, that's a bold statement, not just for copper, but also for gold. I mean, that's more of a statement for gold than it is for copper, I think.
Yeah, I mean, he's also talking his book. He owns a lot of of copper, but I respect the guy a lot. I think he's a very smart investor. It's good to be on the same side of the idea as him. And I think he's a brilliant mining investor that needs to be studied, and folks at least that are in a similar position like myself need to be trying to learn from him rather. And so I appreciate that he shared that because I'm a big fan of his work. But nonetheless, I also think that I think that there's a lot of truth to how this changes that we're seeing with copper. I mean, copper used to be a great barometer for economic growth and sort of your real task to see how the economy is doing. And I also think that now we're seeing a big change towards that, given that the imbalance on the supply side is so severe that is becoming less of a cyclical commodity and acting more of a haven asset, like Robert Freeland actually mentioned. So I agree with him.
You know, it's interesting how we're talking about copper in the context of a safe haven asset, and but at the same time, copper has been accumulated by governments worldwide as a strategic asset as well. It's been being stockpiled, and that leads me to wonder, there is a case to be made for why oil is stockpiled. That's clear. The Strategic Petroleum Reserve in the U.S. and similar petroleum reserves around the world have been used for exactly this particular purpose that we're seeing right now in Iran unfold. Copper makes sense as well. What would be the quote-unquote strategic purpose for central banks around the world to hold gold?
Debt.
Okay, all right.
Amount of debt we have in the system. I mean, gold is I think a lot of people think that sometimes I'm not saying you were asking that question with that idea, but I feel like that question often is placed as if gold is not relevant for industrial purposes and other things. And the main reason that I think people are lacking when they claim these things is that they don't understand the usefulness of gold itself. And the reason why gold is a currency is not because it's shiny and pretty and there isn't enough supply. It's because it's so useful. It's the most useful metal in the world that it became a currency. And now it's so expensive that it can't be used in the real economy. And now it becomes a monetary asset. And so I think that's the importance of all this. And when you think about the anchor that gold has provided in terms of value for monetary systems globally throughout history, and we looked at how much debt we have, not just in the US, but in the rest of the world, it is highly unlikely that we are not in a structural demand process of accumulation from sovereign institutions trying to accumulate the metal itself. Think about the US alone as a great example. The US used to be backed by about 50% of its treasury market used to be backed by gold back in the 1940s. The 1940s we had as much debt as we have today. And, actually we have more debt than we had back then relative to GDP even. And I think that when you look at how much of a treasury market today is backed by gold, it's only about 3%. So Yeah, there's a lot of room for that to change. It could happen through a revaluation of the metal, or just also through a accumulation of the metal. And I suspect that we're going to see a little bit of both.
Okay, if gold does fall, I'm not saying it will, but by the way, Bank of America also cut their gold forecast to 43.60 an ounce later this year. So that's down 14% from their previous forecast. But anyway, if gold does fall a little bit later this year, for whatever reason, does that put pressure on silver? Does that put pressure on commodity economies like Brazil and Latin, for example?
It should. Yeah, no, I should. I mean, if that's going to be, um, if gold prices go lower, the derivative of gold would be potentially real assets with real interest rates would be moving potentially higher, and you could probably see that the dollar would be actually rallying, and that would have an impact as well on emerging markets. So, yeah, I would if I had a crystal ball for gold prices. Where I knew the gold prices will fall, I would not be investing in emerging markets, because that's I think that trade is going to be impacted. That's not my view. I just want to be very clear. That's
Yeah.
not my view, but I'm not
Right.
also stubborn I'm very open-minded and flexible to that. If that happens, I will be wrong on these other positions, most likely.
Okay, let's talk about the miners now. I understand why juniors could be down a lot. For example, look, if your entire net valuation is dependent on the value of the deposit, then the price of the gold is going to affect the price of your mine. I get it. But even at $4,000 gold, we're just below $4,000 today, Tavi, as we're speaking. The price of gold at $4,000 is still very lucrative for the big miners, the producers, right? That's the view that many people on my show have been telling me. Agnico Eagle right now is on my screen. It's down 44% since the top in March. And by the way, it's not even the top in February when gold topped. They went up a lot more. And then are miners really suffering valuations losses at 44%? Does that seem like right to you? Like I'm pretty sure, I haven't looked at the balance sheet and the income statements, but I'm pretty sure the free cash flow hasn't dropped by that much in a short amount of time.
It's fascinating. To be honest, I think that the biggest thing that we're seeing right now is that the seniors are down, in some cases, a lot more than the juniors. And I think this is a tremendous opportunity. When I'm looking at most of the companies like Agnico, for instance, is right now I have been able to accumulate, and I think it's probably one of my largest gold positions right now in my portfolio. And just because I agree, you're not going to see a company that has so many verdicts when it comes to generational mines of that will be producing cash flows for the next years and decades ahead, from multiple fronts. And on top of it, you have one of the best teams in place to execute on that plan. And so, I think that's just that alone is. I started probably accumulating when it was down 40%, and the lower it goes, the more I add to my position here, because I do think that that is the type of company I would like to own in the cycle. And so the markets are giving you that opportunity, in my opinion. There's also opportunities in high quality developer names as well. That are down 50-60% in some cases. So slightly more than the seniors. But funny enough, if you look at the explorers relative to the seniors, the chart is still going up. If you look at the explorers relative to gold, the chart's also going up, meaning that the relative performance of the explorers, which is the riskiest parts of the industry, are actually doing better, more resilient than gold prices themselves, which is not a sign that you tend to see usually a sign that you're in the middle or in the beginning of a cycle, not the other way around. So, I would rank those as important factors to consider as a checklist of thinking about where we are in the cycle.
Yeah. I don't have this data in front of me, and I have to do a lot of digging. But have you looked at the price to NAV, the price to net asset values of some of these large companies, and how that's moved? That ratio has moved.
Oh, it has moved massively. I mean, I think that given where gold prices are, uh, these companies have never. I was looking at that yesterday, actually. Have never been as discounted. So in some
Wow.
cases, you're seeing prices, trade at in some of the seniors. You're seeing prices now. Seniors trading at levels where gold prices were trading well below $3,000 an ounce, and that's not the situation we're in now. And so, and cost hasn't really changed as much for most of these miners. Despite people
Hmm.
saying that energy prices would cause a collapse in margins and all that. It's not true at all. And
How would you
anyways,
describe this kind of move, this kind of investor pullback? Is it, yes, one could call it an overreaction, but something stimulated the investor group to really pull money out and rotate into something else.
oh, for sure. I think that the war, right? The war, breaking out and causing people to think that monetary policy path could change was certainly probably the biggest aspect of that. Also, the dollar, which in the normal environment tends to rally during war periods, and it did again. Was it a big rally like we used to see in the past? No, but it was a rally that was caused, and we also all I think that the combination of the factors is important to appreciate here because we also had such a significant and steep move to the upside in most of the gold miners and gold and silver themselves that in a way it was only normal to see some level of that discounted of that pullback, but that was exacerbated by some of these other factors that I just mentioned. So it's
Okay.
a combination of things, but yeah, I mean, then you have to ask. I think that the biggest question when you see situations like this is can the Fed do anything here and really start, hiking rates by 100 basis points or something like that? If that's your view, you should probably not own gold at all. Like you should probably just move on to something else.
Let's touch base on energy next time. It's very volatile. We'll go over energy in more detail, but just broad strokes here. At $80 a barrel, are you a buyer of energy stocks or crude oil futures, if that's what you trade?
I am more of a buyer of oil and gas. Look, I don't know if maybe I don't know last time I was in your show, but about 8 months ago, 9 months ago, I was extremely bullish energy. Really wanted to own a big chunk of energy companies, and I sold a lot of them back when we saw oil prices going above 100, and redeployed that into copper names mostly. Now I've been putting more capital to work into the precious metals space, and I do like the risk reward of energy here, especially if you hold a large percentage of your portfolio in gold and silver and miners and copper and so forth. I think that these levels of where gold of where energy prices are currently are becoming more and more attractive. Also on the natural gas side of things too. Like there's some great service businesses that are looking more and more attractive also in the US. I am not like I used to own a bunch of the state-owned companies back in Latin America a while back. I don't own them anymore. I'm monitoring that space very closely. I am as well trying to form a private energy company, which is a whole separate discussion. But I think there's an interesting opportunity to do something we've done with the silver space back 5 years ago, which was acquiring the fourth largest silver mine in the world. I think there's some similarities in terms of strategy that you can take in the energy space today. So I'm trying to, accomplish that.
Okay, final question, World Cup prediction. Argentina or Spain?
You
People
asking a
thought,
Brazilian. You asking a
yeah,
Brazilian. Of course, I'm going to say Spain. What are we doing? What are we doing here?
okay.
That's crazy, David. But I mean,
Okay, all right.
England had one job and they couldn't do it. I can't believe it. I'm joking.
Yeah, the prediction markets had predicted France. Actually, that was the highest probability for the winner this year. So prediction markets aren't always right on everything. There we go.
I feel like I was reborn in Spain at the later ages in my life here, as I will be an incredibly big supporter of Spain versus Argentina. I'm sorry for my Argentine friends, but yeah.
I completely understand. So anyway, thank you for that. Where can we go to follow you and Azuria Capital?
They can find my work on X at Tavi Costa and also Substack if they wanted to hear more about in-depth thoughts and how I think about investment ideas and so forth. That's where usually you will find more in-depth work and more detailed ideas. And Azuria is getting ready to launch a fund in the mining space. I love the timing of all this steep sell-off that we're seeing. This is perfect in my view. And so I want to be launching a fund in the next month. I hope to be ready. In the next few weeks, I should have the docs ready, and that's the plan. So yeah,
congratulations, Tavi. That's a big milestone in your career and your life. So yeah, let's look forward to that, and we will talk again when your fund launches. Also, people should check out Tavi's Substack. I'll put that link below. It's growing very fast. Yeah, one of the biggest Substacks in the space, in the finance space. So congrats on your growth. Very happy for your success. All right. We'll put the links down below. Make sure to follow Tavi there, Azuria, and his Substack, and we'll speak again soon. Take care for now.